Coming up on Market to Market. The FDA implements voluntary restrictions on the use of antibiotics in livestock production. USDA's latest figures on agricultural supply and demand reveal bullish and bearish scenarios. And the Grinch steals Christmas trees in the East, while the buck stops here in the Midwest. Those stories and market analysis with Naomi Blohm next.
This is the Friday, December 13 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. Forget 34th Street. The miracle this Christmas may have taken place in Washington this week when the House of Representatives agreed to a budget deal without the threat of a government shutdown. The measure, which restores some cuts previously approved in the sequester, now moves to the Senate, where it faces stronger but likely futile resistance from GOP members. The House also approved a one-month extension of the Farm Bill late this week. Both the Senate and the House have passed their own versions of the 5-year law, but the measures differ on cuts to nutrition assistance and reforms of farm subsidies. House lawmakers approved the extension late Thursday amidst fears that the expiration of dairy subsidies at the end of the year could cause milk prices to rise sharply. Senate Majority Leader Harry Reid, however, says his chamber will not approve an extension because it's unnecessary. Elsewhere in Washington, the long arm of the government stretched into the agricultural arena this week when the Food and Drug Administration implemented a voluntary plan to eliminate the subtherapeutic use of antibiotics in livestock production. On Wednesday, the Food and Drug Administration took the first step towards phasing out the widespread use of antibiotics in animal production, citing a potential threat to public health. The government agency will ask pharmaceutical companies to voluntarily stop labeling drugs important to treating human infection as acceptable in animals that are processed for meat. The goal is to slow the growth of antibiotic-resistant diseases in humans by decreasing the use of the drugs in animals.
Using antibiotics in any situation, whether it's in humans or in animals, creates the possibility of some resistance.
Dr. Hurd is a former Deputy Undersecretary for Food Safety at USDA, which put him in charge of all the meat inspection in the U.S. Lately, he's been researching antibiotic use in livestock at Iowa State University.
It's just like ammunition, if you will, in your armory, and that's what veterinarians need is ammunition. So you don't waste your ammunition. We don't use it for animals that don't need it. You don't use it unless there is a specific infection found on the farm. And then when you find that, you get your veterinarian involved who writes a prescription just like he does for you and says, okay, use this stuff for this time period and then get it out of there. That's what we're in favor of.
Antibiotic resistance is a growing problem, and the Centers of Disease Control and Prevention estimates that more than 23,000 people die annually from drug-resistant infections. Consumers have become increasingly concerned about the issue, and it's one that FDA has tried to address for years. It is unclear, however, how much of the problem can be attributed to the use of drugs in meat production.
From my perspective, the science about antimicrobial resistance and its relationship to antibiotics being used in animal agriculture isn't clear. And the
Craig Rolls, a pork producer in Iowa with 8,000 sows and 43 employees, is able to market 150,000 pigs a year.
Producers like ourselves, we understand that antibiotics are an important tool and we all have to be careful about the way we use them. In the case of growth promotion, the FDA believes that it isn't judicious to use antibiotics in that particular format in the future.
Pharmaceutical companies will be given 3 years to comply with the new guidelines, and in a statement, FDA's deputy commissioner said, "We have high confidence based on dialogue with industry that this initiative will succeed." If the companies sign on, the use of antibiotics to promote growth would be illegal, and prescriptions would be required to treat animal illnesses. If compliance isn't achieved, the Food and Drug Administration could push for legislative change.
I think first and foremost it's important to understand that antibiotics are used primarily for the treatment, prevention, and control. And when we think about the uses that are the most important to producers, we want to make sure that we have a tool like an antibiotic to treat that animal when they do get sick. That's what's important, because we know that the first step in a safe food supply is to have a healthy animal available to go into that food supply.
Retailers count on pulling in up to 40% of their annual revenue during the final 2 months of the year. So far, though, the make-or-break holiday shopping season is disappointing. While an increased number of shoppers were reported by many retailers, the National Retail Federation reports holiday sales numbers fell by nearly 3% from 2012 during the 4-day weekend that began on Thanksgiving. 1 week later, sales fell another 3%, according to data from ShopperTrack, and the number of shoppers plunged nearly 22%. One place where holiday sales may be on the rise, though, is the local Christmas tree farm. The National Christmas Tree Association estimates that 25 million real Tannenbaums were sold in 2012, with a retail value of more than $1 billion. This year, though, a fungus threatens production in the east, while a familiar guest rubs trees the wrong way in the Midwest. Josh Bittner explains.
America's first commercial Christmas tree farm sprouted on the East Coast more than a century ago. But the family tradition of harvesting your own holiday flora remains strong across the country. A few varieties of Christmas trees like Douglas fir and Scotch pine dominate the market. But for the Fraser fir, a resulting chorus of bah humbug is trumpeting in the Tar Heel state.
11 years of work. 11 years of work. Gone.
Fungal pathogens have deteriorated soil quality in North Carolina, causing one farmer to lose up to 80% of his crop to Phytophthora root rot.
See the ooze right here.
Fraser fir has long been a staple of the nation's #2 Christmas tree producing state. But once the soil is infested, the Cadillac of Christmas trees is destined for the scrap heap. While local producers bristle, researchers at North Carolina State University and elsewhere are investigating methods to engineer more rot-resistant trees. As a stopgap measure, Christmas tree geneticists recommend farmers shift the source of their holiday cheer from the hills of Appalachia to the birthplace of Old Saint Nick himself.
There are a lot of nice characteristics about Turkish fir. It does make a pretty Christmas tree, but there's still a lot of things we're learning about the species.
According to the most recent agricultural census, North Carolina harvested more than 3 million Christmas trees in 2007. But the nation's industry leader, Oregon, chopped down more than twice that amount in the same time period. And while the Beaver State produces a slightly different type of tree than that of the Appalachians, experiments with Turkish fir date back 30 years in Oregon. Phytophthora is seen as a threat to several classes of evergreens. The heralded variation could be the savior of many a woeful Carolinian, but the tree comes with its own set of drawbacks. Turkish fir tends to bud out earlier, making it susceptible to late frosts. And it suits the palate of a certain woodland creature whose population has exploded across the nation in recent years: deer.
They'll walk by Fraser fir to snack on the Turkish fir.
But farmers like Jeff Pollard have decided to roll the dice on the alternative conifer.
Good needle retention, good strong limbs, soft, a good aroma. It doesn't smell as good as a Fraser fir, though, I'll tell you that. But it's close.
While awaiting root rot resistant solutions like genetically modified Fraser fir, close may be good enough to ensure a Merry Christmas in North Carolina. Meanwhile, growers in Midwestern states have their own set of hurdles cultivating the renowned Tannenbaum.
We need timely rains like fellows with corn and soybeans.
During the drought of 2012, Walnut Ridge Farm lost 80% of its Christmas trees near Indianola, Iowa. Those disastrous circumstances were documented by Iowa State University, which is conducting a 5-year examination on fertilizer rates and application timing for Canaan and Fraser firs. And while root rot hasn't ruined the rich soil of the Hawkeye State, the buck definitely stops here.
This time of year, early part of the winter, it's buck rub. They take their antlers and just break the branches out of the tree, strip all the branches off the tree, basically marking their territory and just wanting to be ornery, I think, is part of it.
While the Iowa deer herd has declined in recent years, the State Department of Natural Resources reports hunters have harvested over 50,000 deer this year alone. And as males mature, they employ some distinguishing methods to make their presence known.
A buck has picked out this tree to sharpen his antlers on, or just rub on, or wants to be mean to me and ruin one of my trees that's about 5+ feet tall. He's just taken his antlers and scraped and rubbed on the tree. This tree will never make a Christmas tree.
Growers are able to salvage some of the mistreated crop. Wreaths and other crafts allow felled branches a second life as holiday decorations. While deer have proven to be a persistent nuisance over the years, damage is actually down at Walnut Ridge Farm this season. Owner Gary Harmon attributes the reprieve to the crop rotation in adjacent fields he rents out to local farmers. This year's soybeans didn't appear to whet the appetites of deer like grains.
They like corn better than soybeans. They move to where the cornfields are.
The Iowa DNR does offer limited assistance to farmers dealing with these kinds of pests, but Walnut Ridge has taken a more proactive approach.
Folks need to solve their own problem. You don't need the DNR, you just need hunters that can do what they need to do and eliminate the population.
For Market to Market, I'm Josh Bittner.
Next, the Market to Market report.
Record corn production and a bumper soybean harvest are testing the railways, highways, and waterways that move crops to market. Winter doesn't officially begin until next week, but the jet stream has already pushed cold Arctic air well into the Mississippi Valley. Like the river itself, grain shipments on the Mississippi have slowed to a trickle, and barges are being delayed from Minnesota to major export terminals near the Gulf of Mexico. The Army Corps of Engineers said this week that contractors will remove about 2,800 cubic yards of rock over the next several months to ensure that America's primary grain export corridor remains open through the winter. And against that backdrop, the Agriculture Department released its latest estimates on supply and demand. USDA's December supply and demand report focused heavily on demand, and government analysts increased domestic wheat supplies while cutting corn and soybean ending stocks. Despite proposed cuts to the renewable fuel standard, ethanol production is on the rise. And with corn exports expected to be higher, USDA officials reduced domestic carryover by 5% to nearly 1.8 billion bushels. The resulting stocks-to-use ratio fell from last month's report to 13.7%. According to some private analysts, that represents an increase over last season when the stocks-to-use ratio was a tight 7.4%. USDA analysts expect the season average price to fall to $4.40 per bushel. The government cut its estimates on global ending stocks by just over 1% to 162.5 million metric tons. Despite the reduction, the stocks-to-use ratio is 10% higher than last season. This is the largest worldwide carryout in the last 3 seasons, and many private forecasters see the supply as being adequate. USDA cut domestic soybean ending stocks by more than 11% to 150 million bushels. The resulting stocks-to-use ratio of 4.6% is even with last season, but tight by historical standards. Private prognosticators believe there is adequate supply but little room for shortfalls in the South American crop. And after crunching all the numbers, government analysts are calling for U.S. season average soybean price of $12.15 per bushel. Global soybean ending stocks were increased by less than 1% to 70.6 million metric tons. The stocks-to-use ratio of 26% has many private firms calling supply ample, but caution that as countries like China begin to increase demand, there will be little room for production shortfalls. Projected ending stocks for domestic wheat were increased by almost 2% to 575 million bushels. The stocks-to-use ratio fell to 24%, which follows a 5-year downward trend. Private analysts noted wheat has failed to rebuild supplies like other feed grains, but believe there is ample supply to satisfy demand. The government's projected season average price is $6.90 per bushel, down a dime over last month's report. And global wheat ending stocks rose a scant 2% to 182 million metric tons. The resulting stocks-to-use ratio is even with last season at 26%, But private experts noted this is the 5th season without an increase. While analysts believe supplies will comfortably meet demand, they say ending stocks will decline from burdensome to adequate. The report had bearish implications for wheat, was mostly neutral to corn, and was friendly to soybeans. For the week, March wheat lost 23 cents, while the March corn contract moved 9 cents lower. Soybeans traded in a sideways fashion this week as the January contract settled with a gain of 2 cents. Nearby meal prices, however, advanced by $5 per ton. In the softs, cotton traded higher again this week as the March contract advanced by nearly $2.81 per hundredweight. In the dairy market, December Class 3 milk lost 8 cents as the January contract also moved 8 cents lower. Over in livestock, February cattle were unchanged. Nearby feeders advanced by $2.60, and the February lean hog contract posted a weekly loss of $1.83. In the financials, the euro gained 4 basis points against the dollar. Crude oil lost just over $1 per barrel. COMEX gold gained $5.60 per ounce, and the Goldman Sachs Commodity Index lost nearly 10 points to settle at 623.35. Here now to lend us her insight on these and other trends is one of our regular market analysts, Naomi Blohm. Naomi, welcome back.
Hi, thanks, Mike.
We had a bit of a down week in the outside markets, especially in the Dow this week. Talk about what's going on there.
Those markets are facing 2 major fundamental things right now. First being year-end profit taking, and I think that with the tremendous rally that the stock market has had this year, we might definitely see that continue into the end of the year. The other part of it is that the investors are really paying attention to the federal government, and will they end the QE program before the end of the year? Will they do it next week? Even some are talking about with all of the big meetings that are still happening in Washington. And then some are just thinking, you know what, let's just take it easy, take some money off the table, and just kind of cruise into the new year.
But that money they're taking off the table doesn't seem to be coming back into the commodities.
No, it's not. And so that might be something to watch for in the coming year. Will some of those major funds move their money around, and will commodities get it or not? Major question to be watching.
All right, now speaking of commodities, as a buying opportunity, we're down 22 cents in wheat. Is this a buying opportunity? Where are we at in the wheat market?
You know, unfortunately, I don't think it is a buying opportunity, and the reason is because wheat had been holding support so well at $6.50 on the March and on the December board in Chicago prices, and then just this week with the USDA report showing larger ending stocks, both here in the U.S. and still just globally, that wheat market just took a hit, and we're going to probably see continuation of technical selling, even pushing the futures price closer to $6. In which case, then that's your buy.
Okay, $6 is the buy. Now, as we take a look at the quality of winter wheat that's out there with this cold snap, the market didn't seem much phased.
Yeah, and that's kind of surprising. Usually we get some sort of a, buy the rumor, sell the fact, and the market gets a little animated about it, but it just hasn't paid much attention to it. So again, I think it's more that it was actually in decent conditions heading into winter, so maybe that's keeping the market not quite interested in it, but something to be mindful of in the coming weeks for sure.
All right, and keep an eye on that $6 level.
Yeah.
All right, now Naomi, as we take a look over at corn, there has been it's been unsettling to a number of producers to hear the stories about China rejecting some of our cargoes. Can you talk to us a little bit about what's going on there?
Yes, they have been rejecting our cargoes because of the GMO issue. And so they are going in and saying, they're finding it. And so far they've rejected about 3 loads. And so the good news is that those loads can be diverted to South Korea or to Japan. But part of it is that they're playing their games, being China, and they're trying to actually support their domestic prices for now. And also, I'm sure, trying to continue to get cheap corn because our market reacts to that. And the futures price stays low at this $4 level. And any hope of any sort of a rally is just, it gets squelched because little pieces of negative news just keep popping up along the way.
Now, speaking of little pieces of news, we did have the USDA report there. Any longer-term trends this report shed for you? I
would say that for now, in my opinion, we're going to continue to see $4 corn hold and support, and then the question becomes what's going to get planted next year? Because if we plant 3 million acres less corn, then that does absolutely put our carryout over 2 billion bushels. But if we plant 5 million less acres of corn, then that keeps our ending stocks exactly where they're at right now, which keeps $4 totally something in a major objective holding pattern. So there's a lot of question that can happen in that corn market yet. I don't think it's fair to just write it off and say $3 is coming, because there is so much uncertainty and those questions won't be answered until into January and February, when the producers, I think, know better what they're going to be planting.
So for folks out there, producers with corn in the bin, advice to hold off till January, February?
Absolutely hold. And if you at all follow technical markets, if there's anything that can come up, maybe in the January USDA report that could allow some short covering, if you look at a continuous March corn chart, we could see a 23% retracement point, and I'm talking on a weekly chart, so this is longer term. But that could put prices up to $4.96 for the futures price, not $5. And again, this is futures price, so your cash market may not get there. But if we can see some reason for short covering, then that's your target point to be pulling the trigger and making some aggressive sales, because we are going to, no matter what, have a bigger crop next year.
At $4.96?
Yes.
All right. Now, as we take a look at soybeans, we did get a little bit of friendly news out of the USDA report, but we didn't see much of a rally.
Right.
What happened?
Well, a lot of that news was already priced in, because the report came out pretty much as everyone was already thinking it was going to be. And so the fact is that with the tighter old stocks that we have now, the January contract will remain well supported. $13 is the major support on it. I think we'll continue to see that into the end of the year. And then on the upside, $13.50, just always, every time we get up there, it's resistance. So I think your window of opportunity is that you're going to be able to have over $13 beans into the end of the year and possibly into the new year. But with the fact that the global production is just so tremendous, and our global ending stocks are huge, and the United States producer is probably going to be planting more beans next year, don't get cute and try to wait around, because this is your opportunity coming, I think, over the next 2 or 3 weeks.
And now you mentioned U.S. producer planting more beans next year. We've got the November 14 contract still around $11.55, $11.60. Time to sell if you're planning on planting more beans?
Yes, because last year, think about what corn did. People said, I'm going to be planting more corn, but then they never priced it, and then they lost their opportunity, and it was exactly this time of year. On the November soybean chart, on a continuous chart, a weekly chart, there's a very big head and shoulders formation on it that suggests potentially $10, $9 is the downside target if South America continues to have a good growing season, and then if we have one also.
And now what are the reports so far out of South America?
Good.
Okay.
Really good.
Things are shaping up well down there.
Yes.
It does look like a big crop. All right, good things to keep in mind as we head into next year and start making your plans.
Yes.
Now, as we jump over to livestock, on the fat cattle side, we're unchanged this week. Is that seasonal? Are we just looking at a slowdown heading into Christmas, or?
I think it's partly that, but then also we've had just production levels just standing still. Demand is just constant. And then if you look at the chart, it's been trading into a pennant flag formation. And then the January contract, the February contract, has really good support at 133. I think that's going to continue to hold. If for some reason we get negative news next week, maybe we could see that market slip down to 130, but overall, still we have so much long-term friendly news to keep that market well at these current values.
Now, when you say we're in the pennant formation, does that also mean we're building energy potentially for a breakout one way or the other?
That's a great point, and the answer is yes. So it could be if we break out to the downside is 130, and if we can break out to the upside is about 136.
Okay, so we're split the difference right here at 133.
Yep, so next week and then the week after. So it's just a matter of what news comes out. Will it be friendly or not friendly to dictate the direction?
Okay, now in light of all of that, we watched the feeder cattle market this week have a tremendous rally.
Yeah.
Corn prices are staying stable, and so are fat cattle. What's happening?
Well, there's just not any animals that are available because a lot of those calves are being held back and the heifers are being held back. So that market is going to continue to look strong. And looking at the January chart, I think that 169 is the upside target, which was the high from October. And I think that we'll continue to see that market just be the one bright note in the whole commodities right now for stronger values.
Now there has been a pretty decent amount of carry in that market up through about April, and then we start to see it reverse. What's happening there? Is the market anticipating larger supply out that far?
I think you hit the nail on the head, and we'll probably see that next week, potentially even on the cattle on feed report. So that's something to be mindful of. So don't get complacent that the prices will be there forever. But for now, things are looking really nice.
Speaking of that, as we look at the cattle on feed report coming out next Friday, any ways to prepare before the report, since there is that opportunity for news one way or the other on the fat cattle side?
Yeah, I would say the simplest thing would be to go in and look at an at-the-money put and something just shorter term, just in case there's some sort of a negative reaction. I don't think that you need to do anything longer term aggressive, but just keep it shorter, simpler, cheaper, and just get yourself some short-term coverage.
Just get some coverage in case we hit that 130.
Right.
Now, as we jump over to lean hogs, we saw a pretty decent sell-off this week, $1.83 down in the hog market. Talk to us a little bit about what's happened there.
Yeah, the key there is the heavier weights right now, and of course with the lower feed costs, the animals are gaining very well. One thing to be mindful of is that our actual slaughter numbers are down 3% from where the USDA thought they would be. So normally that would be a fundamental factor that would be supportive, except the issue is that the hogs are so heavy, and so the production is actually higher than what they thought it would be. So we've been trending lower for the past couple weeks. 87 is a big support area, and that's about where we finished today. So it's a major do or die point in this hog market right now, and hopefully we see exports pick up more. They're supposed to be up 4% into 2014, but we need that to start happening sooner than later. Otherwise, the trend unfortunately looks like it may continue to slide lower, especially if 87 is broken on support levels.
And we're going to continue to slide even though the PED, the virus out there, is still a massive concern. The market has kind of pushed it aside or priced it in.
I think that the market just doesn't know what to make of it yet, because part of the reason that the slaughter numbers are down now, these are animals that were affected back in June, so they would have been coming to market now. So that's part of the reason the slaughter numbers are lower, and we will probably continue to see lower slaughter numbers go along the way, but again, just the weights are just so high. So the market is in a little bit of flux, and it's trying to decide which supply or demand and production entity is the strongest right now, and that's something we just have to sit and wait and see come in the coming weeks.
Okay, now real quick, on the downside, how low could they go if 187's broken?
Oh, probably closer to 80 even, actually.
Okay, all right, down a big drop.
Yes.
Thank you so much, Naomi, for being with us tonight.
Yes, you're welcome.
And that wraps up this edition of Market to Market. But Naomi and I will continue our discussion and answer some of your questions in our Market Plus segment on our website. You'll also find audio podcasts and streaming video of our program, as well as links to our Twitter feed and Facebook account exclusively at the Market to Market website. And be sure to join us next week when we'll examine the market impact of USDA's latest cattle on feed report. Until then, thanks for watching. I'm Mike Pearson. Happy holidays.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content.